Welcome back, everyone. Part of our role as your partner is to respond to changing market conditions and adapt our client portfolios accordingly. Following the recent bull market recovery, it now looks like we might be getting into a period of even greater market uncertainty. So in today's MarketCast, Senior Research Analyst Arthur Coyne and I will share what we think is driving this uncertainty and our strategies going forward. So now I'll turn it over to Arthur to get started.
Thank you, Reegan. In the third quarter, investors were jittery and stock returns were mixed. U.S. large-cap stocks rose slightly and extended their winning streak to 6 consecutive quarters. However, large-cap gains were offset by declines in small-cap, international, and emerging markets. Bonds held their value as interest rates and credit spreads closed the quarter nearly unchanged. And the U.S. dollar gained relative to other currencies on anticipation of higher U.S. interest rates and rising global risk. The U.S. dollar may also have been supported by comparatively strong U.S. growth. Here we can see that compared to most other countries, the U.S. economy has been doing quite well. The real gross domestic product of the United States is expected to be 2.4% higher this year than it was in 2019, putting the U.S. recovery ahead of most other developed nations. Major emerging economies such as China, India, and Brazil are also projected to have grown from their pre-pandemic levels. However, many developed economies such as Canada, Japan, and most of Europe are expected to remain below their 2019 GDP levels. Now here's a question. With China leading the pack with such strong growth, was there a reason why Chinese stocks had such a difficult quarter? China stocks fell more than 18% in the third quarter. Investors were worried about China Evergrande Group, a severely indebted real estate developer, which was on the verge of collapse. They were also worried about the Common Prosperity regulatory crackdown that's been taking greater state control over China's society and economy. And they were worried about China's electrical power crisis caused by a severe shortage of coal, which has led to factory closures. And yet, while China was a worry for investors, it was not the only worry. Throughout the quarter, investors faced a growing cloud of uncertainty as many new questions arose, such as, will there be a new surge of COVID this winter? Will U.S. tax and infrastructure proposals affect financial markets? Will supply chain disruptions get worse? When will the Federal Reserve start tightening the money supply? Will China's turbulence spread abroad? And it seems that all these questions have one thing in common. Depending on how events play out, they can all lead to either higher or lower inflation, which raises the question, how might inflation affect investments? Well, it depends on the investment. Let's take a look at how different kinds of investments have historically performed relative to inflation. In this chart, we see in box A that investments with exposure to tangible assets have often been among the best performers during periods of high inflation. These investments have also been relatively volatile. And in box B, we see that bonds have generally been less volatile and less sensitive to inflation. But it's worth noting that over time, most asset classes have provided at least some degree of positive response to inflation, with international and emerging market stocks, hedge funds, and infrastructure being among the more inflation-sensitive asset classes. Knowing these relationships is key to tactically managing a portfolio's overall inflation positioning, something that we think is important in this changing environment. So how does tactical asset allocation work? Can it add value over time? To walk through an example and share our tactical views, I'll hand it back to Senior Investment Advisor Reegan Rae.
Thank you, Arthur. We think tactical asset allocation supported by research can add significant value to a portfolio's performance. Here's how it works. When an investment idea, such as a tilt towards a manager or asset class, declines in value, investors who tactically allocate will typically reevaluate their investment thesis, and they may add to the position if the thesis remains intact. Then, as the investment appreciates, These investors will typically trim the position and rebalance into other undervalued investments. In this scenario, an investor who tactically allocates can significantly outperform those who do not. So, let's look at our current tactical views. One of the most striking things about the current market environment is how low bond yields are relative to inflation. In a situation like this, we think it's best to try to limit fixed income exposure. So instead of traditional fixed income, we're using cash and low duration to manage duration risk and to provide a ready source of funds. And on the growth side of the portfolio, we're using hedge and diversifying strategies that we believe are better suited to a low yield, high inflation environment. We believe that global equities as a whole are fully valued. However, within equities, we see small cap, international, and emerging markets as being more attractively priced than U.S. large cap. If stock market volatility remains high, we may also see some rebalancing opportunities. As for private equity, we're continuing to pace positions towards their target. And in real estate, we're on the lookout for distressed buying opportunities. In the coming months, your team at Arnerich Massena will continue to share new investment ideas. Your advisor will work closely with you on specific opportunities as they become available. As we head into fall, we're excited to bring you our annual Holiday Giving Guide, a celebration of nonprofit organizations to which we have a deep connection and have collectively made huge impacts in the lives of our community. We are always honored to share these moving stories of generosity and offer a resource for generous philanthropists seeking ways to give during this season. Look for the Giving Guide coming out in early November. Thank you for joining us today and enjoy your holiday season.